Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. European futures are higher after President Trump and President Putin agreed to talks to end the war in Ukraine. Sources tell us European officials weren't warned about the phone call. Traders now think the first Fed cut of this year will come in December after Jay Powell told Congress there's still more work to do to bring down US inflation. And a big day for European corporate earnings with beats from Nestle, Siemens and Commerzbank. We'll bring you more results and big C-suite conversations over the next 2 hours.
In the meantime, quick check on these markets because risk assets are flying this morning, specifically in Europe. Euro Stoxx 50 futures higher by about 1%. The FTSE 100 lagging slightly, really flat at the moment. You are seeing the 10-year yield at about 4.60. We're going to dive into the CPI implications there, and euro dollar rising as well. 104 handle on that currency. The countdown to the opening trade starts right now.
Thursday the 13th, good morning, a very busy day. UK GDP is dropping right now. It's better than forecast. Baba shares are absolutely surging. You've got 82 companies reporting numbers this morning. We have a frenetic session ahead of us. But all of that, of course, comes against the backdrop of what we are seeing with Ukraine and this Trump-Putin call.
Yeah, absolutely. It's been a really fast-moving story over the last 24 hours, Guy. First, we heard from Hegseth, the defense secretary over in the United States, with some realpolitik for Ukraine about what it can and cannot expect from the United States in terms of support for that country. Then we heard from President Trump that he has agreed with President Putin to start negotiations to end the war. Meanwhile, Treasury Secretary Bersent is in Ukraine trying to get some of America's money back, as it would see it, and access to some of the mineral wealth that exists there. Meanwhile, the Europeans didn't really see any of this coming, or at least they didn't know that these calls were taking place, and they're concerned that Ukraine's being left out of this, and they're frantically trying to make the link between European security and US security.
And in the meantime, the markets are, as we pointed out, flying this morning. You're also seeing a bid into the bond market as well, which brings us nicely to how this geopolitics really squares with the idea of what we got in the CPI numbers yesterday. 460, almost 461 on the 10-year yield, but following a 12 basis point jump in the CPI off of a 3% reading, higher than the 2.9% expected on a year-over-year basis over in the States. This is the line that stood out to me. 2/3 of that advance was led simply by grocery prices, a lot of that driven by egg prices as well. Economists looking through it, but we'll see. Inflation
does seem to be the theme that the Fed is now firmly focused back on. You do wonder whether or not ultimately we are going to see a very extended period of absolutely doing nothing from the Fed. And is the market ready for that? Is that now what is priced? Because at the moment the market is pricing kind of circa one rate cut, but we're beginning to even edge off that possibility.
Yeah, I heard a couple of different interpretations of that inflation data yesterday, some emphasising the sort of sticky, bumpy path down, and others talking about the possibility of resurgence. How this develops over the next 48 hours, next weeks and months will be key. Talking of data and a focus on it, Guy, we have numbers out of the UK.
So we've already had the October-November data on the GDP front. We now get the quarter-on-quarter number, which effectively folds back in the December number. The number is much better than anticipated. Much better than anticipated in UK terms. So we get a 0.1 versus an expectation of a negative 0.1. So that is a much more positive picture and maybe pushes out the possibility that we are going to see a recession over the winter, which some had predicted. The year-on-year number goes to 1.4. Now, that's up from 0.9, which has also been revised higher to 1. How does this change the trajectory for the Chancellor? How does this change the trajectory for the Bank of England? In theory, a more robust economy takes off the possibility, further takes off the possibility that we are going to see a big reaction from the Bank of England, i.e. it needs to cut. Does this include some of the measures that Reeves have included? Are we starting to see some effect of that? It would be maybe a little too early, but we thought the December number was going to be quite negative.
This is better data than the Bank of England had put into their forecast just last week as well, which is probably worth a mention.
It is. So they've got very similar numbers to, I think, what the market was anticipating.
We should mention the pound is ticking up higher on that data, 125.13 where we are on cable.
Let's talk about some of the earnings numbers that we've been getting already coming through this morning. We've seen numbers out of Barclays. The Barclays numbers look very strong. We will be talking to Venkat very shortly. You've also got numbers out of Nestle this morning. Its numbers look pretty positive as well. You've certainly seen that on the top line. Its numbers look fairly favourable as well. You've got numbers out from UniLever. We'll bring you a conversation there a little bit later on. But let's start and talk about what is happening in the banking sector in a little bit more detail. As I say, we'll do Barclays in a moment. Let's start with Commerzbank.
Yeah, absolutely. Let's get to the numbers from Commerzbank and the strategic update coming through from Commerzbank. The Commerzbank CEO, Bettina Orlopp, joins us now. Bettina, very nice to have you on the programme. So a lot of news to get through from Commerzbank this morning. You've reported record profits. You're guiding higher on return on tangible equity. 15% is the target there for 2028. So it all sounds very bullish, very positive. Is this going to be enough to secure an independent future, do you think, for Commerzbank?
First of all, we indeed had a record year. We delivered what we promised in 2024. We had a very good and much better return on tangible equity than originally predicted, was a 9.2%. We have consequently improved our profitability over the past 4 years. So that's a very good and solid basis for the coming years. Specifically, things like net commission income growth of 7% year on year is an important factor we work with. And going forward, we believe that we have a very strong business model, that we can create growth and transformation, and that we create value for all our 3 stakeholder groups, which means investors, customers and employees.
OK, and thinking about one of those shareholders who's been very vocal about what he wants to see from the business, that is Andrea Orcel, of course. He wants to see a plan that strengthens the bank. So he says it's easy to take costs out, and you are doing a lot to take costs out. We've had an update on that this morning. He says it's easy to take costs out, but you've got to do things that make the bank stronger. Tell us how you think this cost-cutting plan makes the bank stronger.
Well, first of all, if you look at our absolute cost base, it is increasing because we are investing also a lot. What we do is we implement efficiency measures to become more efficient, to drive the cost-income ratio down, which is also the expectation from everybody and also from us. So we want to achieve a 50% cost-income ratio by 2028, which is a very good number for a bank of our structure and also in our geography. This is necessary because it gives us also the opportunity to invest, and that's also what we do. We have invested also a lot over the last 4 years with respect to digitization, and we will invest even more in the next years in technology. AI will be a very important factor for us, on the one side, to increase the value proposition for our clients and to serve them better and faster, but on the other side also to make processes more efficient and also more safer against fraud and other things.
Bettina, good morning. It's Guy. You're targeting a return on tangible equity by 2028 of 15%. Is that number high enough? UniCredit's already in the 17s and is pushing higher and higher. And I'm wondering whether or not you feel that you can do better than 15. Are you still being conservative with that number?
Well, I think, it's a linear improvement. We came a long way. Back in 2020, we had a negative return on tangible equity, and we have improved steadily year on year. And this is what we also intend to do in the coming years. And 15%, if you compare it to the European peers, I think it's a very good number. Also given, and this is probably the conservative part, that we are assuming that the macroeconomic environment will stay difficult for Germany specifically. So in our assumptions for the 15%, we only assume that we have a growth rate in Germany in the upcoming years of 1%. We assume that the interest rate level will stay low. So there are many things factored in, which makes this plan achievable, but also ambitious on the other side.
So you are saying that you believe that there is still potential to lift that ROE target higher than 15% if the German economy improves, and this morning we're talking about a potential peace dividend coming out of Ukraine, and if maybe interest rates stay a little bit stickier than currently is priced into the market. Are those two factors that you think could lift that number, that ROE, that return on tangible equity, higher than you are currently suggesting?
I think we focus at the moment on really achieving what we now have put on the table. And that means also short term on 2027, for example, at 13.6%. That will clearly is enough to also earn our cost of capital, which is an important factor for us. And we really focus on implementation. And if you look on the capital return potential, which is out there now up to 2028, is huge. And I think we should focus first on the delivery. And then, as you know from us, we will review our targets year on year. And if we think that there is a potential to increase, we will definitely do so. But at the moment, we have a program out there, and we are fully focused on the implementation.
So, Bettina, let's dive into that program, if we can, a little bit more and get a little more of the details of some of the cost-cutting measures you've been talking about. Commerzbank announcing about 3,900 job cuts this morning, most of them expected to be in the back office. Does that specifically mean most of them are in Frankfurt? How are you thinking about the location and the regionality of those job cuts?
Yeah, I mean, the job cuts are very much related to two things. One is offshoring, and the other thing is digitization of our processes. And that concerns specifically corporate center functions, operations, and staff functions, and it's primarily in Germany. On the other side, and that's the investment part, which we also have, we will further recruit also in Germany a lot of talents. We will build up also still salespeople. We have a growth of staff in mBank, and we will increase the staff in our DTCs, our digital technology centers in Sofia, in Prague, and in Łódź, and in KL. And we will also invest further in new skills.
Bettina, I want to ask you as well about a model that a lot of banking experts are saying may actually work well for Commerzbank. Things like closing retail branches, things like going all digital with a traveling sales staff, just some ways, more radical measures to bring the costs in line. Is that a model you would rule out?
Well, we feel very comfortable with our branch network of the 400 because our experience also of the past years is that we still have a number of clients who really want to have this personal interaction. So we think that we have found a very good model now with the 400 branches. And what we now will do is also flexibilize a little bit the capacity management in that to really make sure that we meet the needs of the regional clients. And let me come back also to the headcount reduction. I mean, we have a demography here in Germany, which is if we won't do anything, we would get older and older, and also in our staff. So we also need to make sure that our age pyramid is intact. And this is also why we believe that the job reduction we have now announced will be handled in a very social, responsible way, because we think, and we are convinced, and we have also agreed that already in an agreement with our Works Council to achieve it just by natural attrition, by reskilling and age instruments, which is the most social, sensible way you can do it.
Bettina, a pleasure to have you on the program. We look forward to seeing how this all unfolds. Commerzbank CEO Bettina Orlopp there joining us on that earnings day.
Let's turn our attention to another big bank. Barclays is reporting numbers, the first of the major UK banks to drop its numbers onto our screens. Let's talk about the numbers before we get to Venkat. Investment bank revenue for the fourth quarter, 2.61 billion. That is ahead of estimates. Pre-tax profits also higher than expected at 1.66 billion. The bank has announced a further share buyback this morning. CS Venkatakrishnan joining us now, the Barclays CEO. Always a pleasure. Venkat, good morning. The numbers are better than anticipated. This time last year, you announced new targets. You announced new returns to shareholders. You gave the bank a boost. Are you ahead with this set of numbers 1 year on the way you thought you would be?
Look, I'm very happy with the results we have demonstrated. If you look at our profits this year for 2024, it's £8.1 billion. It's 24% ahead of the numbers for 23. It's based on a 6% growth in revenue, a 1% reduction in cost, holding impairments flat. If you look more broadly at what we laid out in that 3-year plan to which you referred, our ROTE this year, we guided to greater than 10%. We printed 10.5%. We announced that greater than £10 billion worth of share buybacks and dividends over the next 3 years, 24, 25, 26. And with the share buyback we announced today, we've done $3 billion for this year. And we are rebalancing the bank. We are, we've deployed about 13 billion pounds of RWAs into our UK-facing businesses. It's more than a third of the 30 billion we've planned. And the investment bank, which was 58% of the bank in RWA terms a year ago, is now 56, on its way to 50, which is our target. So, so far, so good.
Venkat, we've just been having a conversation with Bettina Orlopp, the CEO of Commerzbank. She's targeting an ROTE, return on tangible equity, of 15% by 2028. Do you think Barclays could achieve a number similar to that? How high could that figure go? Yeah. You've got UniCredit in the high teens now. Does Barclays have work to do on that number?
Well, we already have businesses that are performing well above that. So if you look at the announcement today, our Barclays UK business has produced 23% ROTE for the last year. Our UK corporate bank is in the mid-teens, I think 16%. Our private banking and wealth is in the high 20s. It all depends on the mix, and we are shifting the bank in terms of mix to the higher returning businesses. We've also said that we've put out a plan till 2026. 2026 is not an end date. It's a point in time, and we'll look forward from there.
Venkat, it's Kriti in London. Talk to us a little bit about your trading revenue here. I mean, it's not a secret that all the banks on both sides of the Atlantic have gotten a little bit of a boost driven by the volatility from the Trump administration. How long do you expect that to last as we start to see a little bit more complacency creeping into these markets?
Yeah, well, the markets, as you said, Kriti, have been quite volatile towards the fourth quarter of last year, which we've reported, and it's stretched into the first quarter of this year. It gives opportunities for our equity businesses, where I'm standing on the equity floor, and our equity business over 2024 was an outperformer, as was our securitized products business, and we've been gaining market share with clients. Those are the structural things I look for, and it's a structural performance we try to create, and then we'll take advantage of cyclical factors as and when they come. But our plan is based on a very conservative estimate of what the market wallet will be.
Let's stick with the Trump theme, perhaps from a different angle here. There's a big expectation in these markets and in these banks that the deregulatory agenda from the United States is going to have a spillover effect into Europe and into the UK, even pushing some of the regulators on this side of the pond into loosening some of those strings. How are you thinking about that? Is that spillover effect something you're seeing tangibly in the first few days of Donald Trump?
So the regulatory agenda in the U.S. has been pretty well signaled by President Trump before he came into office, and it started to be enacted. In the U.K. and Europe, you're already seeing in the U.K. examples of the government taking a line towards a more fairly balanced regulatory profile. They've spoken about, in the UK, the Competition and Markets Authority and what's called the Financial Ombudsman Service. I expect that you will see some rebalancing. But, I should say that we want the rebalancing in the context of strongly regulated markets. We think all the major banks, us included, are advocates of a well-regulated financial system. It's what makes London great. And so there should be some rebalancing, but in the context of a well-regulated financial system.
Good morning to you, Venkat. Sticking with the theme of what changes in the United States might bring, there's been a lot of expectation going into another Trump administration that perhaps we get more M&A, the animal spirits argument. But then there's also a lot of uncertainty. What do conversations around M&A look like to you?
Yeah, I think you're absolutely right. There's a balance that's going on. On the one hand, what you've got is deregulation, which allows companies to think more confidently about whether choices that they make will indeed be permitted by the government. Then you still have a relative stability in financial markets, both in interest rates and in credit spreads. And then lastly, though, you've got tariffs, which introduces questions regarding particular countries and particular industries. So I think companies are going to have to balance the three, and over time we will get a clearer picture. It's too soon to tell.
Too soon to tell on that one. Let me ask you, Kriti was asking you about trading revenues. You talked in glowing terms about the equities team. I wonder what comments you have on FIC revenues this morning. I see that for the fourth quarter, the number came in a little below what some of the analysts were looking for. Is there any explanation you can reach for there, Venkat?
Look, the fixed income is the great strength of Barclays. The house of Barclays was built on fixed income. We had a weaker start at the start of the year, but especially in our European rates and our macro businesses, it's been picking up through the year and into the fourth quarter. Our securitized products business in the US has been particularly strong. So I'm very confident about fixed income performance going forward.
OK, confident about the performance. Thank you very much, Venkat. Thank you for joining us. Barclays CEO, CS Venkatakrishnan, with us to talk about those results this morning. Futures pointing higher. We'll be back with more on that. This is Bloomberg. Welcome back. This is the opening trade. Let's get to a conversation about these markets with our Markets Live executive editor, Mark Cudmore. Mark, we've talked a lot about earnings stories so far this morning. There are big geopolitical developments that we touched at the top of the hour and we need to return to now. The euro's going higher and stock futures are going higher on the prospects of this US-Russia conversation around Ukraine. Tentative expectation, tentative or more than tentative perhaps, risk on for Europe. Looks like the path ahead.
I think so. I think very much tentative. I think, this is definitely a relief rally on the chance that we might be seeing an end to the Russia-Ukraine war. And it's in the context that European assets have been very beaten down over the last long period of time. Obviously, European equities have been doing well recently, but the euro is very cheap. The power of the euro-dollar rally shows, how much kind of a war discount is priced. But I think, we have no idea what the path of these negotiations might take, how long it might take. And so I think if someone's buying the euro-dollar on this narrative of, peace in the east of Europe and therefore better times ahead, I think that's a very, very dangerous trade if that's your main argument for doing so.
Do you sell the euro-dollar on the fact that it looks like the Fed ain't going to be cutting rates anytime soon?
No, I don't think you do. I think that the big news the last 24 hours in currency markets is Donald Trump gave the green light for the 2025 bearish dollar trade to begin. What he did is he made a comment to undermine Fed policy. He said there should be lower rates. Now, this would be bad at any time, but doing it just before a hot inflation print with a load of inflationary policies is extremely dangerous for the dollar. It's sending a message that this is a country where the government is going to continue to pressure policy to be too easy for what inflation needs. Now, there's another country where that has happened very prominently in the last few years, and I can tell you the Turkish lira has depreciated an awful long way. Of course, the US dollar is not the Turkish lira. There's very big differences. But the fact is, as long as that we have a government undermining monetary policy, not letting the restrictive policy go into place, that is negative for the dollar. When it comes in the backdrop that the uncertainty around trade policy is undermining US markets' exceptionalism, this is the green light to start the bearish dollar trade. Now, it'll continue to be extremely volatile because every tariff headline will get a knee-jerk dollar move higher. But it's going to be a rocky path of the dollar slowly depreciating.
Mark, I'm going to ask a controversial question, as I always do. What's the likelihood that before the end of the year, we get a hike before we get a cut out of the Federal Reserve?
I think it's very likely. I think economic data might say that we should. Kriti, as you know, I've been in that camp for a long while. I always thought, from early last year, I thought we might only get one cut. Obviously, we got more than one cut. I never believed the amount of rate cuts priced, and I always said this year it might be a hike more than a cut. Now, given what's happening, given what Donald Trump is saying, I think it's going to be very hard politically to give that hike and until it's absolutely warranted, which means there's a good chance we get no move either way from the Fed this year. But yeah, I'm very open to the idea that it could be a hike as the next move potentially later in the year.
Contrarian take as always. Mark Cudmore joining us from the Markets Live team. We thank you so much. MLIV Go for more analysis from him and the team. Guy.
So about the earnings, looks like Siemens, Adyen, Commerzbank, Delivery Hero, all are going to be higher. That certainly is the initial indication that we're getting. But take a look at defense stocks this morning. They look like they could be opening sharply lower. Names like Leonardo, Rheinmetall could be falling this morning as we price in the peace dividend. RELX CFO Nick Luff is going to be joining us shortly as well. Another big company out with numbers. That is next. This is Bloomberg. The big story this morning is what are we going to see in Ukraine? What kind of a peace deal could be being pushed forward by Donald Trump and Vladimir Putin? The US Defense Secretary, Pete Hegseth, is arriving in Brussels. He is there for a NATO defense meeting. I think he's speaking. Maybe we should just listen in to hear what he has to say.
Not mine, certainly not a betrayal. As I said to our allies yesterday, we recognize the incredible commitment that has been made over many years. And no country, as the President Trump has pointed out, has made a larger commitment to the Ukrainian mission than the United States of America, north of $300 billion. So the United States has invested in stabilizing those front lines after the aggression of Russia. There is no betrayal there. There is a recognition that the whole world and the United States is invested and interested in peace, a negotiated peace. As President Trump has said, stopping the killing. And so that will require both sides recognizing things they don't want to. That's why I think the world is fortunate to have President Trump. Only he at this moment could convene the powers that be to bring peace, and that's a welcome sign. My job as the defense secretary, working alongside NATO, is to ensure that the defense capabilities of this alliance are as strong and robust as possible to deter any future aggression on the continent. That's our role, to be leaders in NATO, and that's what we'll continue to do. Thank you very much. Appreciate it. Thank you.
The Defense Secretary of the United States arriving at NATO headquarters in Brussels ahead of the meeting that is going to be taking place there, pushing forward the idea that peace is possible, but also pushing forward the idea that Europe needs to spend more, significant more. He's talking about 5%. Does Europe really have the capacity to deliver upon that at the moment? If that's the case, it's really interesting to think about what we are seeing in terms of stocks right now. Defense stocks are lower. In theory, judging by the numbers we've just been hearing from the Secretary of Defense, Europe is going to need to be spending more. However, at the moment, it looks like Europe is pricing in the peace dividend. That is why futures are higher, though it looks like defense stocks this morning are going to go lower.
Yeah, absolutely. So we'll certainly keep all of this geopolitical news flow in focus as we get towards the open of markets. There we have European equity markets trading higher. This geopolitical context, of course, is the big picture over markets this morning. We also have plenty of earning news to digest. And we're pleased to say we're joined by the CFO of RELX, which is one of the biggest companies on the FTSE 100 these days, Nick Luff. Thank you very much, Nick, for joining us to talk through your numbers right now. Analytics and decision tools company really flying over the last few years as the AI theme really takes hold. I wonder, in terms of your guidance and your numbers, what is the new messaging to markets? We've talked many times in the past, Nick, about what AI can really deliver here. Do you see any step change in what the business is able to deliver because of AI?
Well, you've seen another strong set of numbers this morning with consistent growth, but it's accelerating growth. And within these numbers, you can see a step up in our legal division, for example. But we haven't been improving the growth trajectory across the group for some time. And that's really been about using data and analytics, and then more recently, generative AI on top of the extractive AI we've been using for many years. So that's what you can really see coming through strategically in these numbers and in this performance this morning.
So the step up in legal, how significant does that become, Nick?
Yeah, look, we've been using AI in our risk division for many, many years, and it's our biggest division. But when it comes to the legal division and our scientific division, where you've got much more text-heavy content, then generative AI can become very powerful. And we've been working with the large language models ever since they really became commercially viable and useful, and developing products and putting products into the marketplace. Alexis Plus AI, which has now been in the marketplace for 14 months, getting very good traction. And we can continue to do that. And we've just in the last few weeks launched the next generation of product in legal that are called Protégé. So the pace of evolution, the pace of change, the pace of innovation is very much coming through. And you can see that coming through in these financial results.
Nick, I'd like to talk about maybe what's going on the other side of the Atlantic here. Walk us through your exposure specifically to the U.S. government, especially as we talk about some of the cost-cutting measures that are happening there. Does that affect your business, and in what way?
Yeah, the US is a very important market for us. About 60% of our revenue comes from there. Only a small fraction of that is directly with government. But actually, we have some interesting products that can help reduce waste and help government agencies reduce fraud. Fraud is very prevalent in the government sector, much more so than in the private sector, actually, where people using banks and other financial institutions and other commercial online retailers and so on using our products to prevent fraud. Those aren't used as much actually in the government space. So we have products that can certainly help government as they try to address those sort of problems.
Nick, it feels like you're an AI company. Certainly the conversation we've had thus far, there is a big focus on that. Is there an AI trade in exhibitions? Like, is that still part of the business going forward? Should that be part of the business? Is there any conversation around whether or not that still fits?
Yeah, look, we're a data and analytics business, and we can use AI, or a user of AI, and applying it to our content set, our trusted curated content, and applying that in specific domains such as legal, such as scientific, and in the fraud and identity space and so on. Exhibitions is clearly it's a slightly different type of business, and it's through history that we have that business. But there's a bigger digital opportunity there too, actually, using data about people who are attending events, industries we're bringing together when we hold these events, how we can make the connections, add more value to customers coming to those, and that's what really our exhibitions business is focused on right now.
So still core. Okay, I'll take that. Just yes or no, still core. Is that still a core business?
Still very much part of the group.
Okay.
We're absolutely focused on driving that digital opportunity in exhibitions, absolutely.
Okay. The legal business, there's a lot of lawyers going to be watching this programme, Nick, I suspect. Does your legal business imply fewer lawyers are required going forward?
Well, I mean, we've been making lawyers more efficient for many years using digital products. Moving from print to online and so on. Often that results in more legal work. There's an opportunity actually for the access to the law and access to justice and so on. Making that affordable and actually making laws more efficient is part of what we do. So we haven't looked back over history as we provided tools to make lawyers more efficient. Actually, a lot of that's gone back into the amount of legal work that's done. Lawyers are still very much part of the process here. It's actually about how do you use this technology to most effective for your clients, and that's what we're focused on.
So you think lawyers are big fans then, Nick? Let me ask you how much of a big fan you are of being listed in the UK. I feel like this is a perennial question, but any business that's listed in the UK, works in the tech space, has a lot of exposure to US revenues, is going to get asked this question periodically. Any temptation to list elsewhere? I know you have secondary listings elsewhere.
We do. We have a listing in New York. We do look at our listings from time to time. You might remember a few years ago we simplified our complicated Anglo-Dutch structure and moved the primary listing into the UK. So that is something that we look at from time to time. We have no current plans to change, but I'm sure we'll keep looking at it.
Thank you very much, Nick. Nice to speak to you, the RELX CFO, Nick Luff.
Let's go to another earnings story that's catching our eye this morning. That, of course, is Delivery Hero. They're coming out and beating expectations on those fourth quarter results. You're already seeing trade rate pricing that is suggesting that the stock is going to open higher in just a few minutes when we do get the opening trade across Europe. They're also looking to buy back around 1 billion euros of bonds, about $1 billion equivalent, using proceeds from the recent public listing of Talabat, its Middle Eastern unit. Let's bring in now the CEO of Delivery Hero, Niklas Östberg. I'm pleased to say is joining the program. Niklas, a pleasure to have you. Walk us through the story. I mean, this idea that you are using the IPO to offset really some of this kind of bond purchases, that must suggest that the IPO is doing pretty well. How do you feel about Talabat? Then we'll discuss your broader earnings.
Thank you very much. The IPO on Talabat was a success. It was the largest tech IPO for 2024. We used that to improve our balance sheet. So right now we sit on 3.8 billion in cash, and some of that we will use then to buy back some convertible bonds.
Well, a good chunk of those earnings and that strength is really coming from pretty stringent cost-cutting measures and this kind of expansion and acquisition, almost roadshow that I feel like Delivery Hero has been on for the last few years. Niklas, how does that evaluate and how does that kind of affect the way you operate in Asia to take on some of the major players there?
Look, yeah, we have done cost cutting, being very cost efficient over the years, and I think there's a lot left yet to come. But I think the profitability is mostly come from growth. I don't know, we grew outside of Asia with 27% in the fourth quarter, so very strong, better than any peers out there. Asia is a little bit weaker, but I think we have a good momentum. So we've seen some encouraging sign end of last year, beginning of this year. So we're pretty optimistic that we'll do a good fight in Asia. In the end, it's also not about, I don't know, winning, losing. Obviously, I'm very competitive, but it's about serving the customers. And as long as we do a good job there, I think we'll be fine.
Nicholas, good morning. It's Guy. Serving the customers. Let's just talk a little bit about that. Is your priority the customer right now, or is it your investors?
It should always be the customers, but of course we haven't had the best couple of years in the stock market. I think the business have done very well. We've improved profitability with almost 2 billion over the last 3 years, despite come from the COVID highs. I think now we have a little bit of an easier journey. Growth is coming up, so we see an acceleration in growth, and I think that should also help us drive profitability. And I would hope that the shareholders will be pleased with this. But it's always the customers that matters, and if you deliver good results to them or good product to them, then I think eventually investors should be happy to.
Thinking about something that might deliver for customers quite literally, and you'll be hoping it delivers for investors, Nicholas. I know you've been looking at robotics and drone delivery. How much of a step change to the margins in your business, the way you do business, can this kind of technology bring?
Yeah, we have looked into both drones and robotics, and we do a little bit test here and there. I think we start seeing that economics can get to the same level now. And I think if you look on a few years forward, and it should be significantly cheaper to do a drone or a robotics delivery than a human. At the same time, it will take some time. And I would also say that the margin improvement that we will see will probably be passed on to the consumers to make it cheaper and better for them, and that should hopefully rather accelerate growth. And again, I don't know, if you drive growth, it's also going to drive profitability. So, the margin improvement will improve our growth and profitability.
Nicholas, let's kind of combine all of this. You've clearly said you want to put the customer first, but the question, therefore, that spins off that is, at what price? Investors have been watching what you're doing, and maybe they are starting to feel a little bit more comfortable with the business. Does robotics, do things like that help you square that circle, i.e. you can deliver a good product for the customer, but also profitably? Because that's always been the challenge, and it is still an incredibly fine margin business that you operate in. Is the customer service at any price still the mantra?
I don't bet on robotics now. That will not be the driver of the growth in the next couple of years, and also not on the profitability. In the end, it will improve the customer experience. It will improve the cost that we can serve the customers, and hopefully, therefore, also drive growth. It is a low margin business, but we are on a gross profit good in every market that we operate in, and I expect we'll continue to be so. But in the end, we want to serve the customer at a lower cost to drive more volume. And I think that's what I'm hoping for over the years with robotics and AI. And,
Nicholas? Thank you very much. Thanks for joining us today. We will return to the earnings story shortly. We are also watching the geopolitical story as it develops, and it's developing here in Europe. The US Defense Secretary Pete Hegseth and the NATO Secretary General Mark Rutte are speaking from Brussels. Let's listen in.
And we certainly feel that way, and our investment reflects that. We echo your sentiments on defense spending. The president has said 2% is not enough, and we're going to argue that up to 5% is the necessary investment from NATO countries to ensure we're able to meet the threats of the future, whether that's Russia on the continent or an ascendant China who has their own ambitions as well. But also the defense industrial base, not just in Europe, but in the United States as well. We need the ability to create the systems and the munitions necessary to sustain a fight. One other thing I would add is foreign military sales, and that's something the United States is committed to expediting the process of ensuring that our allies get what they need when they need it. that is critically important. And then, as you saw yesterday, there's one man in the world capable of convening the parties together to bring peace, and that's President Donald Trump, which he demonstrated yesterday in speaking to both Vladimir Putin and Zelensky, and bringing about, we believe, a durable, lasting peace on the continent, which his goal is to stop the killing and bring that peace, that it's in the interest of the continent and the United States to do so. We look forward to even more robust conversations today, realistic, honest, straightforward discussions, but all under the guise of full support and belief that a strong NATO alliance is what will defend the free world, alongside ensuring America maintains that leadership role. So, Mr. Secretary General, thank you.
Mr. Secretary, thank you so much.
You got it. Thank you.
Okay. See you guys later.
Secretary of Defense Hegseth speaking at the NATO headquarters just a few minutes ago, saying Donald Trump is the one that is making things happen in Ukraine. He is going to push this deal forward. He is going to deliver peace. Europe, though, must pay up. Kind of feels like this morning that Donald Trump is setting the menu, inviting the guests. Europe, though, probably has to pay the bill. Let's talk to Oliver Crook. He is in Munich ahead of the Munich Security Conference. Ollie, what did you take away from what the Secretary of Defense had to say?
Yeah, exactly. Setting the menu, someone else has to pay the bill, but I'm not even sure everybody's invited to the table, right? This is part of the conversation here that's going to be in Munich, the Munich Security Conference. This is going to be the first high-level meeting between the Trump administration and many of the European leaders, and it's going in sort of the backdrop of a week of just sort of huge activity, particularly on the issue of Ukraine from the Trump administration. Trump speaking to Vladimir Putin on the phone, really breaking with the U.S. policy over the last 3 years, breaking with European policy, really just trying to move fast and get things done. While at the same time, you have Scott Bessent, the U.S. Treasury Secretary, in Kyiv trying to build out the economic ties with Ukraine, because the U.S. wants to leave itself the space to still support Ukraine, while at the same time making sure it gets paid back in some way. How can they do that? Maybe these sort of mineral deposits, having access to the economy. These are the sorts of relationships, while at the same time you have the U.S. Defense Secretary, Pete Hegseth, who's just been speaking, has been in Brussels, has been reiterating the fact that basically he does not see NATO membership for Ukraine, even in the longer term, as a realistic outcome, talking about, again, the realistic outcome, meaning that Ukraine will have to surrender some territory. The word realistic keeps coming up, and this is really sort of evident of the Trump administration approach, being much more pragmatic, basically saying, listen, we're going to leave some of these principles. We really just want to get things done. For the Europeans, it puts them in a very sort of challenging position ahead of these meetings, because what we understand is they have really not at all been consulted on any of these calls, and what we keep hearing from the United States is that Europe needs to play a bigger role and that they need to spend more money on defense, up to 5%. That 5% number of GDP for NATO spending is not going away.
So, Ollie, what kind of timeline are we looking at here for the Europeans to actually show up? What does that look like?
Well, listen, I think that, this is potentially going to accelerate things for them. I think that really the difficulty is they, don't know what's in the peace plan for Ukraine. They don't know how to sort of what they're going to be asked to do to support it. We know there's going to be much more spending required. But here's another question. When we talk about a potential ceasefire, and again, we don't really have a timeline on this. This could take months. This could take a much, much longer. We don't really know. We know that Trump wants to have these meetings with Putin to try to hammer this out, but we don't really know what the timeline is going to be. What the ultimate question is going to be is longer term, who is footing the bill? But also there's this very difficult and very challenging conversation about peacekeeping troops within Ukraine after a ceasefire. The United States has made it very, very clear they want no part in that they want the Europeans to step up. I have spoken to senior lawmakers that sit on the Bundestag Defense Committee who are actually more of the hawkish people who support Ukraine. They are very sort of opposed to this idea of potentially German forces being in Ukraine longer term in order to preserve that peace. So all of these questions are going to be sort of fundamental. And again, it doesn't feel good for the Europeans when they hear from Volodymyr Zelensky, the president of Ukraine, speaking just a few days ago, that basically security agreements don't exist unless they're backed by the United States. Does not literally look very good. And this is going to be a key feature of this meeting here, the Munich Security Conference.
Ollie, thank you very much. Bloomberg's Oliver Crook live for us in Munich as we cover all of this geopolitics, heading with all this Ukraine news towards that Munich Security Conference. Let's focus back in on the stocks, though, that could be on the move this morning. Defence stocks certainly in the mix, but Joe Easton has a rundown of some of the earnings stories this morning. Joe.
Morning, Anna. So one of the big earnings reports today is Siemens looking really strong on the sales for this one, and the net income smashing expectations, rising by around 50%. Now, this stock has had a decent run over the past 6 months or so, as we can see by this screen here, up around 33%. And the CEO talking earlier about the electrification demand. That does look like it's the key driver of that strong report today. Then in terms of Nestle, this one looking a little bit better on some of the sales. There have been concerns around people trading down, of course, over the past couple of years, and that has hit the stock, as we can see from this chart, down 29% on a 2-year basis. So potentially expectations low, and we might see a bit of positivity. It is still a favourite stock on the street in terms of the buy ratings. We can see 14 buys on the stock, just a sole sell rating, but quite a few on the sidelines. Then finally, Barclays, this one looking pretty good as well. Now, the company is returning more cash to shareholders, doing really well in the investment banking business, something that we've seen from the US peers, particularly JP Morgan, giving a similar comment earlier this week. We can see that stock has done well over the past year, and in the coming days we'll get reports from the rivals as well, like Lloyds, HSBC, NatWest. They've had a good start to the year given those positive comments around Bank of England cuts potentially. So keep an eye on the UK banking stocks in London this morning.
Joe, thank you very much. Joe Easton with an update on some of those companies that are reported numbers. Guy, I know you're focused on some of the defence names.
Yep.
We might see some movement in those. Adyen in the payment space, some numbers coming through from that company, and that could be a big gainer at the end.
In some ways, the defence story is really counterintuitive to what you would think. So the logical thing is, if Hegseth's talking about 5% defence spending, that, in theory, should be epically positive for European defence companies. But on the other hand, there's a peace dividend, and that would suggest that maybe the stocks go down.
Is this the buy the rumor, sell the news kind of moment?
I don't know, but you've also got to figure that getting to 5% requires a lot of working capital. Anyway, the market opens next. This is Bloomberg. Thursday the 13th, good morning. Couple of minutes to go until the opening trade. Yesterday was about a hot CPI print out of the United States. You can see the effect that had very clearly. As we come through, we see this big drop. Markets then rally, which is interesting. Europe goes out kind of pretty much where the United States closed. And since then, the story has moved on quite significantly. We've got a potential peace dividend to price into Europe. We've got a whole load of earnings, and we've got UK GDP to factor in as well. Kriti, what do the futures look like?
Well, the futures are flying everywhere across Europe, except for one spot, and that's right here in the UK, where you are seeing it flat relative to an almost 1% move in Euro Stoxx 50 futures. Perhaps that peace dividend is indeed helping. But the outperformance is also earnings-driven, some of it coming from the DAX as well. There's going to be a big sectoral story. DAX at the moment outperforming the rest of the continent, higher by 1.3% in the futures picture, Anna.
Yeah, we'll certainly look for the further east you go, perhaps the higher risk assets might go today as a result of some of that news coming out of the build-up to the Munich Security Conference, certainly coming out of Brussels today with those NATO meetings ongoing. So that's why we'll watch defence stocks. We'll also be watching the banking sector, of course. We have had numbers out of Commerzbank, big changes there. There's job cuts, there's a higher target being set. Is it enough? Will it fend off Andrea Orchel and his interest? We'll have Barclays on the move as well. We've had perhaps a little underperformance there on the FIC side of the trading book, but equities stronger and other parts of the business outperforming. Let us talk about UniLever as well. We've had numbers out from this business. Fourth quarter sales coming in better than expected, starting a new share buyback and announcing they are listing their ice cream business in 3 different locations, Guy.
So, Anna, what's going to matter more this morning? Is it going to be the geopolitical story? Is it going to be what happens with defence stocks? Is it going to be about earnings? Or is it going to be about the macro picture and what's happening there? We're about to find out. It is time for the opening trade. Let's look at some numbers for you and get an idea of what is happening here. The FTSE 100, as we've anticipated, maybe the outlier today, starting in the negative territory side of the ledger, flirting with positive territory, though. But remember, sterling is sharply higher today on the GDP number. You have to factor that into your thinking. Shell has gone ex-dividend. Bear that in mind as well. Stoxx 600 is up by 0.2%. The earnings story is broadly going to be positive. The peace dividend story is broadly going to be positive for the bulk of Europe, except the defence sector. How is that going to fare this morning? On the other hand of the defence sector story, you got a 5% target coming out of the Trump administration. That should be positive. Okay, so here we go. The Stoxx 600 is up by 0.3%. The IBEX is up by 0.4%. We are waiting on the CAC. We are waiting on the DAX. We are waiting on the SMI. There is a whole range of stocks this morning that are clearly maybe slightly trickier to price to get the bid offer aligned. Let's wait and see exactly how some of these markets open. In the meantime, let's take a look at the sector story and the single stock story to get an idea of what is going on, Kriti.
Yeah, absolutely. When you're looking at the breadth in this market, I think that's the takeaway here. I'm looking at a Stoxx 600 with 425 stocks trading higher, 75 lower. So breadth is really your friend in today's risk rally. But you really did mention where you start to see the Achilles heel, and that is certainly in the defense space. We are still waiting for some of the opening numbers coming out of Germany. But the likes of the FTSE 100, for example, you're already seeing the likes of BAE Systems taking a little bit of a hit. You mentioned Shell. Shell's take down about 2.4%.
Yep.
So right off the bat, you are getting an early insight into what this maybe rally in this day might look like.
Shell's ex-div, so we just need to factor that in.
Yep, absolutely. We're flat on the FTSE 100, as you guys have been saying. Still no opening price on the CAC 40 and the Xetra DAX. So it seems as if people are looking to express some investment intentions around the macro story that we've been dealing with, the geopolitical story we've been dealing with, what we've heard from Pete Hegseth, what we've heard from Donald Trump, and what we've heard from Scott Bessent. They've all been active on the subject of Ukraine. So all of that is working its way through the markets, and we don't have opening prices there. Yep. We do have corporate reporting, though, giving us some of the interesting stories of the day. Barclays is down by 4.3% on the back of those numbers.
That's a really big move to the downside. What is that based on?
Is that the FIC revenue miss, perhaps?
That was something that the top live blog was flagging a little earlier, that perhaps there'd been a lot of expectation when you looked at how the US banks had been doing, trading the Trump trade, that had paid off well for them and had led to the, certainly on the fixed income side, that had been a positive. So maybe it's something to do with that. But we will dig into the details there.
Equities were strong, though. So anyway, it's fascinating to see exactly what is happening there and why it is down as much. We'll dig into that one very, very carefully to figure out what is happening. We are still waiting on some of the other numbers, but you've got a real range of stories this morning. Is Europe up on the range of stories, i.e. the corporate earnings story, or is it up on the dividends, or is it up, on the peace dividend story? Is it a broader story, Euro higher, stocks higher, Europe having a better prospect going forward from here? Or is this I'm buying the numbers? Ultimately, markets buy the numbers. Do they buy the bigger picture this morning? Which one is it?
Well, it's interesting that basic resources is the best performing sector, which, typically moves around on China news and global growth stories. And maybe people are attaching and drawing lines between what might happen in Ukraine and a growth story for Europe. That would be, but we'll see. The DAX now open then, up by just over 1%. And we'll dig into where those gains are coming from.
And off the bat, you go ahead.
Sorry, right off the bat, Rheinmetall's down by 4%.
That's exactly what I was going to say. You read my mind. But we kind of saw the microcosm of what's going on in the FTSE as well. Defense is the underperformer. We continue to see that across the board. But again, you said it absolutely right. Breadth is really your friend in the rest of the market. Green across the screen. It's an interesting, is this a fundamental trade? Is this an earnings trade? Let's bring in a true expert here. Valerie Noel, head of trading over at Seas Group, joins us this morning. Valerie, pleasure to have you on the program. You picked a great day to join us. We're just trying to debate around the table. This green on the screen that we are seeing today, is that a peace dividend story in terms of a peace in Ukraine, or is this an earnings momentum story when you look at some of the individual moves? Valerie, what's driving the trade this morning?
Well, Europe is green, obviously, but Europe also is cheap. We know that it's cheap compared to US. We know also that there is less technologies company in the European index. There is a lot of bank. There is a lot of cyclical inside. So, and obviously, euro is cheap also. So, plus 10% since the beginning of the year. But Europe is also very, very cheap. So, it's that's a normal way to start the day. I think today the market is very resilient. The economy is very resilient, even in US. So not a big surprise.
Valerie,
for this one.
Can you walk us through the defense story then? I mean, this is the trade that almost, I think you're seeing broadly as well in the European stock sector. The last 5 weeks since the start of the year has been an outperformer for Europe. Is that a blip? Is that a rotation? In the same way that we're looking at defense stocks, for example, today, the outperformer of 2024, the underperformer of the last couple of days, and certainly this morning as well. Is this just a rotation, Valerie?
I think it's definitely a rotation. Every January is the same thing. you really see the rotation from the client. If you look at it, also the ETF, the financial ETF, the pharma ETF is going much, much better than the tech since the beginning of the year. So it's also sectorial, but it's also because it's the seasonality. And, tech's done very, very well last year, but I think you also need to have diversification. And the client, this is what client wants at the moment. They want diversification, and I think Europe gives this diversification for the moment.
Valerie, we're talking this morning about the possibility of a peace dividend. Very mindful of the fact that it's probably too early to really talk about a peace dividend. But if we do start to move in that direction, Valerie, I mean, there would seem to be obvious things you'd want to lean into around Poland, around Germany, around parts of Eastern Europe. What springs to mind for you?
Well, for sure, as I said, everything's diversification. Everyone was really concentrated on the same stock. And the dividend part, I mean, that's a great sector or great theme to watch for 2025.
So that's something you want to watch. In terms of the European growth story, Valerie, what are your thoughts on the European growth story? Because it's been moribund for a long time. The ECB expected to be the backstop there. Fiscal actors, their hands are tied. But on the other hand, if we do see peace in Ukraine, perhaps the conversation changes a little bit. So what are you expecting to invest in when it comes to European growth?
Well, for the moment, at the bank level, we have a better position. I mean, we are more positive on US than Europe, but we see Europe as a good opportunity to make a diversification, as I just said. And there is also a very great company in Europe. So if you look at, as an example, the numbers of Richemont a few days ago was very strong. So the luxury sector is coming up, financial sector. Also, there is a lot of banks inside the indexes. So we still have a lot of things to watch and to do in Europe, even though we lack for the long term US better.
Valerie, good morning. OK, so you like the US better, but let's talk about this diversification trade that your clients want. What are they diversifying from, and why are they diversifying? Because diversification over the last few years has equaled underperformance. Are they OK with that? Do they still think that diversification equals underperformance? Is that a price worth paying?
No, I mean, we still very focused also on AI and tech, because I think that's also what clients want. But valuation in US are, higher and higher. And clients feel also more comfortable to divest. Can be stocks, European stocks, but we can talk also about gold. That kind of diversification is the main point for the moment for our clients.
What about fixed income? It seems as if rate cuts are being priced out around the world. The Bank of England is the latest to see that trend. Yes. Obviously, the Fed has seen it significantly. Yes. Maybe we'll see what happens with the ECB. What do you see there?
Yeah, well, I think the numbers yesterday of the CPI was very strong. It's also just a reminder that the last 2023-2024 CPI in January was very, very high, was actually an outliner compared to the rest of the year. So let's see, first of all, in February, what the CPI will come out for the US. And for sure, there is a dilemma with between the tariff and the inflation. So I think the Fed will monitor, obviously, very carefully what's going to be the data. And for sure, the fixed income trader, we know, was pricing a rate cut in September, and it's moved to December. And we probably even hear also that maybe it's going to be in December or not at all, or maybe some hike. So we still believe one rate cut will happen for the Fed. And obviously in Europe, you have the bank's going to, majority of central banks going to ease. And yes, it's going to be a big and challenging year for everyone.
Valerie, great to catch up. Useful insight into what your clients are thinking. Thank you very much indeed. Valerie Noel, Head of Trading at Seas Group. Let's take a quick look at the Core 6. What is happening here in Europe this morning? Technology is under a little bit of pressure, but it's not that much pressure because, as you can see, Schneider's up, ASML is a little bit higher. Luxury is bouncing reasonably strongly as well. It's interesting to see Nestlé doing as well as it is. Let's talk about some of the other single stock moves that we're watching so carefully. Joe Easton has the details.
So we are seeing some weakness in the defence stocks, as expected, following those headlines around Russia and Ukraine last night. Now we're seeing weakness, particularly in Rheinmetall at the open. That one was down around 4%. BAE was lower as well. Leonardo taking a hit. There is a good note out from JP Morgan saying they would potentially buy into the weakness in the defence stocks, given we are likely to continue to see upward pressure on defence spending, given the stance taken by Donald Trump with the NATO spending targets. Then another stock in terms of the earnings that's falling today is Barclays. Now, I was asking traders in my chats earlier about this one. They're saying some people were expecting the company to upgrade some of their targets, particularly the return on equity target was seen as something that they would have lifted today, but they haven't done that, and therefore we're seeing Barclays coming down, one of the worst performers in the banking stocks this morning. Then in terms of Siemens Energy, all that automation and electrification boosting the firm today. The sales better than expected, and net interest income, or the net income at least, rising by around 50% for Siemens on that key line for them. So boosting the DAX index today in a big way. Then another stock down in the mid-caps. This is in the payments. We've got Adyen soaring. This is a beaten down payment processing company, but they are seeing a revival in some of their volumes. The Amsterdam listed company saying today they've seen an improvement. It's that stock rebounding today. Now, Neste, we've got to not get our Nestle's and Nestes mixed up this morning. You don't want to mix up your diesel and your Kit Kats. Neste is falling 12%. This is actually due to their renewables business. There are lower volumes, lower sales on their renewables business, according to the Finnish company. That's hitting that stock pretty hard this morning. And another stock to wrap up the decliners is BAT. Now, the company has announced an impairment on their Canada business. This is a legal issue that was over in Canada. That does seem to be hitting the stock. It's related to litigation that's been going on there, and potentially they've also had some other FX impacts, according to the company. British American Tobacco falling 6.8% in London this morning.
Joe Easton from our equities team, we thank you so much for walking us through some of these stocks that are keeping an eye on. And Joe mentioned at the start, we are seeing some of the defense stories as well. We're continuing to see actually some of the stocks that are moving in, maybe tying to reconstruction, the likes of ArcelorMittal, for example, the likes of Siemens. Some of that, of course, is going to be part of the earnings story that we're getting. Siemens is flying. But again, we keep talking about this idea of whether or not a peace dividend story is ultimately buying the rumor, selling the news in terms of defense, or is it maybe something more in terms of that, well, the defense spending isn't as needed immediately as maybe previously thought.
It's a complicated, multifaceted story, isn't it? I remember when we had the CEO of one of the defence companies in here around this table asking them about those two drivers of spending. On the one hand, there's war on the continent, and that drives spending on defence. On the other hand, there's shifting expectations about who spends what within NATO, and that drives a slightly different profile. Kriti, you flagged a really interesting index, which is the UBS Ukraine ceasefire and reconstruction basket that tracks 33 European stocks that are levered to the resolution of something on the ground. As premature as it is to be talking about resolution,
it absolutely is, and this is, I think, a really interesting point as well, because some of the things that is coming out of the U.S. administration has been not just reconstruction, but talking about trying to get some of those critical minerals as well. That's the partnership, the economic trade that at least has come out from Donald Trump, not only in the campaign trail, but in the last couple of days as well. So when we're talking about reconstruction, it kind of makes sense that maybe some of the defense stocks do play a little bit lower relative to, say, more of the things like steel manufacturers, some of the companies, including Schneider Electric, who may have more interest in the kind of future of Ukraine as well. So we'll see how that index specifically shakes up. I'm curious to see how it shows up in tomorrow's trade, maybe more than today's.
Rolls-Royce still at a 52-week high this morning. Big defence business, it is still tracking higher. So this is not universal in terms of the names that we're watching. Safran, a little flatter. It's interesting to see, if you look at the 52-week highs today, the banking sector is by far and away where we're seeing the bulk of the 52-week gains. So across the board, a series of names generating those kinds of numbers this morning. The banking sector goes from strength to strength.
Yes. Let me talk a little about UniLever and what we've heard from them. The UniLever business saying it's going to list its ice cream unit in Amsterdam, London and in New York. The company expecting a modest improvement in profitability this year. They've also begun a €1.5 billion share buyback. The UniLever CEO, Heinz Schumacher, has been speaking to Bloomberg's Francine Lacroix. She began by asking him how Trump tariffs will impact the business.
we have invested a lot over the last couple of years in markets to be a bit more self-sufficient. I think we did that generally after COVID. So in the US, we've invested quite a bit. Around 85% of what we sell in the US is produced in the US. And it's about the same when it comes to ingredients. Now, there are flows between Mexico and the US. They are not material to the group, and as well as between the US and Canada and vice versa. So we're still navigating through that. We are localizing production where we can to adapt, and then the remaining impact is not material to the group.
And so these are, for example, minimum impact for, I think China's one of the only producers of ascorbic acid. Does that impact how you have to find it or how you have to make it?
Yeah, so there are a number of ingredients from China, that we do export to the US, or that we import in the US. But once again, it's not material to the group. We're talking somewhere around 150 to 180 million on an annual basis, and that's before further mitigation. So I'm quite confident that we can navigate through that if it were to come to effect.
Hein, can you talk to me about M&A? So there's a wild speculation that you're buying Wild deodorant.
Yeah, I mean, I will not comment on M&A or on projects, or on speculations in the market. I'm reading them, of course, with great interest, but I cannot comment on that.
But are there a couple of brands that you would like to own?
Always.
So it wouldn't come as a surprise to anyone if something were to happen.
Yeah, look, I mean, we're very focused with our GAP 2030 plan on driving organic growth. And I think we're very disciplined about acquisition. So, in 2024, things come our way, but, we've been in divesting mode. We've done UniLever Russia. We've done local food brands in the last quarter of 2024 to come to a more streamlined food business. And yes, we're also looking to grow, but I want to first draw a line on the portfolio and saying, hey, here's where we're going to play. And then when something really attractive comes up, we will take a look. We did two things. K18 in the US, large market, hair care, premium,
Yeah.
We did Minimalist in India in Q4, skincare brand, premium, good market India, skincare in the heart of what we want to do, and premium. So that ticks a number of boxes, so we will keep looking.
Hein, talk to me a little bit about these listings. So you want to list in different places. Mm-hmm. Does that mean costs will also go up?
So the ice cream business will be demerged, and what we've announced today is the road towards separation. We've announced three things. One, the designate chair, Jean-François van Boxmeer, currently chair of Vodafone, ex-CEO of Heineken, great person to be the chair of that business going forward. We've announced the country of incorporation. It is headquartered in the Netherlands, in Amsterdam, and the Netherlands will be the country of incorporation, and the listing locations. So that's Amsterdam, following the country of incorporation, as well as London and New York, to limit technical flow back and to give our current shareholders the opportunity to hold ice cream going forward.
But you don't worry that it basically spreads it a bit too thin, or that, again, it just incurs extra costs?
Yeah, no, I think, for us, I mean, this was really important. I care about, obviously, the shareholders that we have at UniLever today. At UniLever, we are at those three exchanges. So to the extent that you can replicate that, and you don't lead to a forced technical selling for those shareholders or for that new ice cream company, I think that was the bigger reason to do it.
That was UniLever CEO Hein Schumacher speaking to Bloomberg's Francine Lacroix, of course. We'll be back with more stock moves coming up next. This is Bloomberg. Welcome back to the opening trade. 22 minutes into today's session. It is a really busy one. The general mood is that markets are going higher. The FTSE 100 underperforms for reasons of composition and ex-dividend and various other factors. But the Stoxx 600 up by 0.5%. We're seeing strength coming through, certainly on the Xetra DAX this morning, Guy. DAX is having a good day. Number of factors behind that. Certainly one of them is what is happening with Siemens. The company stock is currently up by 5.5%, 5.6%. Digital orders look pretty good. The cash flow story looks pretty good as well. Robust demand seems to be the overall narrative that we're getting for its electrification products. Think AI, think about what is happening with the energy story. But how does the Trump tariff story fold in? How does the inflation story fold in? We've been speaking to the Siemens CEO, Roland Busch.
we had a very strong, promising start into our Q1. Growth was up 3%, driven by Siemens Healthineers, by smart infrastructure and Siemens Mobility with 6%, 8%, and 10% growth. Digital industry holders still back, but on the other side, we saw an order intake growth in digital industries by 6%, and also our automation business in order intake was up 6%. So that's very promising that we get more momentum in our automation business in particular going forward. Free cash flow and net income was up 50%. So we had a very strong start. We keep our guidance for the full fiscal year. So therefore, we are quite happy. To your point, yes, smart infrastructure, electrification business has still growth. It's not only data centers, it's the whole sector which is growing. And for automation, we see signs of recovery. You remember we had a high stock which we're building down. We're coming from 14 weeks. Now we are down to 9.5. So we are bottoming out here anytime soon. Therefore, momentum is coming. We see increase in the demand from semiconductors, electronics, aerospace. Also chemical is picking up, which is a leading indicator. So we are quite positive that this comes. But we have to look for another quarter before really having a clearer sign. But it's moving in the right direction.
The CEO of Siemens speaking to us a little bit earlier. Let's stay in Germany.
Yeah, let's stay in Germany. We had numbers from Commerzbank. We spoke to Bettina Orlopp, of course. So the company coming through with a raft of job cuts and setting themselves some tougher targets to meet for the years ahead. Now, Bloomberg Intelligence saying those targets already look like a stretch. Others saying, are they enough? Do they go far enough to fend off Andrea Orchel and UniCredit? We spoke to the CEO, Bettina Orlopp, about that subject. This is what she said.
You're assuming that the macroeconomic environment will stay difficult for Germany. We only assume that we have a growth rate in Germany in the upcoming years of 1%. We assume that the interest rate level will stay low. So there are many things factored in, which makes this plan achievable, but also ambitious on the other side.
Bettina Orlopp there, the CEO of Commerzbank. And Kriti, these numbers were initially well received. The stock went higher, but now it's underperforming, down by 0.3%.
Absolutely. And it's not the only bank underperforming. Barclays is not having a great day either. Their earnings coming in. It looks like you're starting to get analyst commentary here saying that the results are underwhelming the market. To sum up the mood, Jonathan Pierce over at Jefferies saying it's unclear from the numbers whether there's an actual catalyst to drive the stock. And you are seeing those shares take a bit of a beating despite the fourth quarter investment banking revenue coming in a bit higher. Take a listen to what the CEO told us earlier.
We are shifting the bank in terms of mix to the higher returning businesses. We've also said that we've put out a plan till 2026. 2026 is not an end date. It's a point in time, and we'll look forward from there.
The CEO of Barclays, they're talking about reshaping the businesses. Trading volume did great. We'll see if that continues.
Yeah. Are the targets high enough? Is the ambition big enough? I think probably is maybe the question that the market is asking this morning. If you're looking for a re-rating, you've got to deliver. Coming up, we're going to take you back to what the politics is looking like this morning. Certainly one of the key drivers, the geopolitical narrative around Ukraine for the European equity picture that we're watching. President Trump and Putin agreeing to end the war in Ukraine. They're going to start talks. Daniel Tannenbaum from Oliver Wyman is going to be joining us very shortly to give us a take on how we should be watching this whole process unfold. That's next. This is Bloomberg.
It's certainly not a betrayal. As I said to our allies yesterday, we recognize the incredible commitment that has been made over many years. And no country, as the President Trump has pointed out, has made a larger commitment.
That was the US Defense Secretary Pete Hegseth there speaking to reporters in Brussels as NATO defense ministers meet. Those meetings are ongoing. We're monitoring those for further news flow. This after President Trump says he's agreed in a phone call with the Russian leader Vladimir Putin to start negotiating an end to the war in Ukraine. For more, let's bring in Bloomberg's Oliver Crook, who's in Munich as we work our way towards the Munich Security Conference and all of this very much on the agenda there, Ollie. What more did Pete Hegseth have to say? Talk us us through some of the latest news lines, because he certainly caught everybody's attention yesterday.
Yeah, that's right. I mean, it's been a really sort of consequential, 36 hours for the war in Ukraine and really what the U.S. policy is going to be going forward under President Donald Trump. There has been a lot of questions about what his position is going to be, what his posture is going to be, what this peace plan looks like that has been devised by the Trump administration and will potentially be revealed to some of the European leaders here in Munich by Keith Kellogg, the envoy for Ukraine and Russia. But what we heard is the beginning of the contours of what that plan could include. We heard it from Pete Hegseth yesterday about basically NATO membership for Ukraine, even longer term, seems to be off the table. There's going to be some sort of land conceits that will have to be given up to Russia, it seems, but also, the potential not just about what is going to go day to day in terms of the peace plan for Ukraine, but the longer term in terms of what is expected from Europe. Have a listen to what else he had to say this morning about NATO defense spending.
Even 2% of GDP is not enough. 3 and 4, and ultimately, as President Trump has said, 5% of defense spending is critical. A realization that there is a Russian war machine that has sought to take more and more land in Ukraine.
So this is part of the U.S. strategy to, on the one hand, say basically, yes, we do want a strong NATO. Yes, the U.S. is a strong partner. But at the same time, Europe needs to be doing a lot more. I think a lot of the concern for the Europeans and those who have been sort of involved in trying to maneuver this war and move this war in a certain direction in Europe over the last few years is that basically, even if we know that NATO membership for Ukraine is a long shot, even if we know that there's going to be land concessions that will have to be made in a peace agreement, saying that out loud before you enter into formal negotiations, basically only after a phone call between Donald Trump and Vladimir Putin maybe sets the stage for something that certainly potentially the Ukrainians don't want and the Europeans certainly don't want.
Ollie, what are the Europeans saying about this? They don't have a seat at this table. Does it even matter how they feel?
I mean, I think that is actually principally going to be their concern of basically what leverage do they have? What levers do they have to pull with the Trump administration? Again, I think Guy put it very well a little bit earlier. It seems that the United States is going to set the menu and send the bill to the Europeans in terms of what the peace in Ukraine is going to look like. What the Europeans are hoping for now in the very first time is the high-level meetings between the new Trump administration and the Europeans here in Munich. It's going to be J.D. Vance. It's going to be Secretary of State Marco Rubio. Keith Kellogg was the sort of author and executioner of this potential plan for peace between Russia and Ukraine. The question is, how much input are they going to get? Are they just going to be told, hey, listen, this is what the United States wants. This is the course of action that we're going to get on. The train is leaving the station. Time to get on board. That is what they're going to be very, very sort of afraid of. And it doesn't help when we hear from Volodymyr Zelensky, the president of Ukraine, who is very sort of realistic about this, realizing that basically there are no security guarantees for Ukraine without the United States. It puts the Europeans in a very tough position. And frankly, I think the reality of the situation is European foreign policy has not caught up with the reality of this Trump administration and its unilateral action on foreign policy.
Absolutely. Everybody's certainly playing catch-up this Thursday morning. Oliver Crook in Munich, ahead of the Munich Security Conference. Thank you very much indeed. So our next guest argues that President Trump can use economic statecraft to push for a Russian withdrawal in Ukraine. Daniel Tannenbaum is a partner and global anti-financial crime practice lead. Let's try and put those two things together. Oliver Wyman, and joins us around the table this morning. Good morning.
Morning.
What do you make of this?
It's definitely been an interesting 24 hours. I do think by President Trump announcing actually first that he spoke to Vladimir Putin and not President Zelensky kind of sends an interesting message as we look at what may unfold going forward, especially with Munich coming up in the next few days. It may have been premature. Even offering these talks to Putin legitimizes him in a situation where Russia is clearly in the wrong in this situation. And I do think there's more economic pressure the U.S. and the Western coalition could apply to Russia's third country allies to further isolate them, making this potentially a better outcome for the Ukrainians at the end of the day.
What do you think Trump's objective is here?
His objective is to show that he can close, that he can make a deal. But the question is whether that deal is reasonable and something that the Ukrainian people want is really the question mark.
Does Trump want something else? Does Trump want something for the United States out of this? Is it lower oil prices? Is it what is it that? Is there a kind of alternative way of thinking about the way he's approaching?
Well, we've already seen the U.S. telegraph that it would like access to mineral rights in Ukraine in exchange for ongoing support. And Zelensky has come out saying, like, that's a reasonable trade, that we give something for ongoing defense. But what Secretary Hegseth said yesterday calls into question what some of that defense really looks like going forward.
You're a sanctions guy. We always get you on when something in Iran happens, or China or Russia as well. What are the economic levers that the U.S. and Europe maybe can pull here?
So if you think about the BRICS plus countries, there's still a lot of trading partners for Russia. There's still a lot of trade that's happening with countries trading with the U.S., U.K., and EU that are also trading with Russia. There's more pain that can be imposed on these third countries that refuse to make a choice, that could be doing things, supplying goods to Russia that are essentially supporting the war effort in Ukraine. And I think there's more that could be done to force these third countries to make a choice through secondary sanctions.
You mentioned certain countries. We're getting headlines that India is already trying to kind of get around some of that. There's also a big question. I know we're talking here about Ukraine and Russia as well. In the recent news, we've talked about how the likes of China, for example, can get their hands on U.S. technology, potentially circumventing export controls. Walk through the holes, the security holes in U.S. sanction structure at the moment.
Well, I mean, when you're talking about physical goods, it's very difficult to truly police that. I mean, goods get transshipped from countries around the world, ultimately ending up in Russia, but not going direct. And there's been transshipment through China, the UAE, Turkey, India. The question is, can you begin to punish those that are perpetrating these acts or that are facilitating these acts to really provide an example of mess around and find out, essentially, if you want to continue to support this war effort?
Daniel, good morning. I was looking at some editorials just in the last 24 hours before we had the latest news flow, but that said that President Putin will stop this when the money runs out, and that the person who's writing this particular editorial saying that the sanctions will work, they just take a long time. Is it worth thinking about that sanctions environment tightening up? I mean, President Trump has even said he's prepared to put tougher sanctions on Russia. Is that something we prepare for or no?
I think it's something that hopefully is prepared for. They just announced yesterday that person who will be atop the U.S. sanctions policy regime in the U.S. We've yet to really understand this person's point of view. There's more that can be done. And using sanctions more aggressively, the Biden administration was very reluctant to go too hard using sanctions, using secondary sanctions for fear of spooking the broader market. They were quite focused on unintended consequences. I think this is a time and opportunity to take advantage of President Trump's strengths and really take the gloves off economically.
Can I ask it, going back to what you were discussing at the beginning there with Guy about the latest news flow and about Ukraine, and you referenced Scott Bessent has been in Ukraine and has been talking about mineral wealth there, talking about access to some of those metals. And just to expand a little on, is it very unclear then what that money is for? Is it for a bill? Is it for money already given from the United States to Ukraine? Or is it for support in the future? Because from what Hegseth was saying, no boots on the ground, that really raises questions about how much support in the future.
I think there were always questions about American boots on the ground, but in terms of the chances of Ukraine entering NATO, which seemed good up until, frankly, yesterday when Secretary Hegseth made those comments, I mean, this is definitely a look forward in terms of how can there be some sort of a balance for ongoing support and defense of Ukraine should this conflict end, and essentially the U.S. asking what's in it for us.
Do you think Europe would like to go back to an era of cheap Russian gas? There's this kind of conversation about what Trump wants out of this. Europe feels really divided in terms of the way it looks at Russia. And German industrials clearly have suffered as a result of what has happened in terms of the energy story. There are vast swathes of political parties in Europe, particularly in the East, that don't have the antipathy for Moscow that maybe is shared elsewhere. And I'm just wondering if, sort of collectively, you feel that everybody's really committed. You talk about sanctions being tightened up. Do you think everybody really is, on balance, still kind of going down that road? Is this peak sanctions for Russia? Is this as tough as it gets?
I don't think it needs to be. I was actually with the EU sanctions envoy on Tuesday here in London. I mean, remember, they've had 15 successful sanctions packages that have gotten consensus across the bloc, with a 16th in the works as we approach the 3rd anniversary. I think there is more that can be done, and sanctions are like a vice grip where you're always kind of leaving a bit more to tighten to exert additional pressure. I don't think we're done yet, and I do think the consensus has been reached. It's taken some give and take, but there has been generally good consensus, at least across the member blocs, that have approved 15 rounds of sanctions over the last 3 years.
Is there a concern of consistency here? I mean, just in the last couple of weeks, we've seen kind of the saber rattling from Donald Trump and the administration. Tariffs one day, rollback, delayed, different sectors. I can appreciate that a ceasefire or a war-related agreement may be different. What is the consistency, the volatility, the trustworthiness, the credibility of this kind of deal that's being forged?
That's a great question. Consistency is not something that we've really seen over the last month of this new administration, as we've seen kind of a blitz of different actions to make good on campaign promises and a broader policy agenda. I mean, look, there's still a desire for countries to do business in the dollar, to do business in the U.S., and I think there is some broader trust. Right now, until we see what comes out of General Kellogg in the form of whatever this plan is, I think it's really hard to tell exactly where the U.S. stands. Coming out with some of the details that came out yesterday are a bit concerning because it does feel like Ukraine is left with the short end of the stick of a country being invaded. But I think it's too early to say that this is not an ally worth trusting.
Daniel, I wonder what you make of one of the proposals that Ukraine has made recently, which, they've been calling for a long time to be able to access the frozen Russian assets and to spend that money perhaps on U.S. defense supplies. Is that the kind of argument that might win some friends in Washington? You know,
it's interesting. The frozen assets debate has been extremely quiet since the start of the new administration. You had Dileep Singh in his Deputy National Security Advisor role in the last administration worked out the plan to basically tap into the interest gain from the immobilized Russian assets. The talk of actually seizing the Russian sovereign assets seems to have died down for the moment. You know, it obviously is a large pool of wealth that could be tapped into. There's just never been a sovereign set of assets at that scale that have ever been seized before, and it does seem like there's very few politicians that really want to go there.
Yeah, a lot of worries in Europe about precedent being set.
We're excited to see you. Thank you for coming by. Fascinating conversation that, of course, is still developing. Daniel Tannenbaum, partner and global anti-financial crime practice lead over at Oliver Wyman. Now, we, of course, will continue that conversation. We're going to be live from the Munich Security Conference all day on Friday with a lineup of interviews that are getting a key seat in these negotiations, and certainly in terms of the defense story, including the German Armed Forces Chief of Defense, the Saab CEO, the Kongsberg Defense and Aerospace President, and the German Foreign Minister as well. This all, of course, comes as we see defense stocks take a beating this morning.
Absolutely. Let's turn our attention to what is happening with some other stocks that we're watching so carefully. Nissan. Think of the Renault connection here as well this morning. Nissan is cutting its full-year operating income forecast. The numbers that it's delivered this morning have missed estimates. This, as we see, a conclusion of talks between Honda and Nissan, and that conclusion is that we are not going anywhere with this deal. Nissan has got to find its way through this. Is Honhai the solution? How does Renault deal with this? What is Renault's expectation here? A lot of moving parts still with this story, but basically what we've seen this morning is Nissan cutting its full-year operating income forecast. It has missed estimates, and that just underlining, Anna, the challenge that car company faces.
Yeah, absolutely, and so we'll continue to watch that, where we can see integration within that sector and where we can't. Still ahead on the programme, we'll return to the UK eco story. The UK economy grew unexpectedly at the end of last year. We'll discuss next with Henrietta Pacmont from Allspring Global Investments. This is Bloomberg. Welcome back to the opening trade. 8:47 here in London. The session pretty positive, reflecting the global geopolitical news flow, but not everywhere. The FTSE 100 down by 0.7%. Sector exposure very different, of course, to the ZDAX and the CAC, which aren't making gains. And we see that on the screen just there. In terms of the UK data we had out this morning, the UK GDP coming in a little better than was expected in the last quarter. We got a positive number, not a negative one. Recession dodged seems to be the way you could describe that in the short term. Henrietta Pacmont, Senior Portfolio Manager at Allspring Global Investments, joins us now. Henrietta, nice to have you with us. So let's think about UK assets in the context of, yes, recession dodged. Bloomberg Economics, though, still saying demand still looks kind of weak. But we are, in the context of this data, pricing out some of the rate cuts we'd expected to see. Where does that leave you on gilts?
Well, we're still reasonably positive, actually, on gilts, because we do think that the growth story in the UK is closer to that of Europe than that of the US. The inflation picture is coming down. So, it's good, actually, for the UK to have a positive number. It's not huge. We're talking about 0.1%. But I think it's good and it's helpful for the government at this point and their plans going forward.
Can I go stateside then? So that's the UK story at the moment. The latest in the US, we had that inflation number out, of course, yesterday. And I've seen two different interpretations of what's happening with US inflation. Some people focusing on the fact that we have been coming down up until we got stuck. And so just talking about it being sticky and bumpy, we're just not there yet, as if the direction of travel is still downwards. And others talking about, well, this could be resurgent inflation, as if we're at the start of something. How are you looking at the inflation story?
So I think it's one data point, and we're probably still in the camp that we are on the sort of bumpy way down. However, we are looking at the US. We do have a new administration, and that new administration is bringing uncertainty. And I think that includes uncertainty on the inflation front. So whilst we're probably more comfortable with the inflation picture in Europe and the UK, more question marks, obviously, on the US side.
Can I combine Anna's two questions? Talk about the US and talk about the UK. Gilts feel like they're just trading with treasuries at the moment. Almost kind of irrelevant of what is happening in the UK. What do I trade gilts on UK data or do I trade gilts on US data?
There is a correlation, absolutely, and that's not helpful for the UK government at the moment. And yes, I would say that they are trading together, but you should see a bit more divergence between the UK and the US.
I mean, there's a correlation. I mean, some people suggesting that the rate cuts from the Bank of England, really haven't been transmitted properly.
Correct.
That's the extent of the transatlantic influence.
Yeah. And I think if you look at what the UK government is trying to do, it's not helpful for them.
Yeah, certainly not helpful for them if yields stay high. So your expectation that gilt yields stay incorrectly high. I'm trying to think of the right word to putting it. In context of what is happening in the economy, gilts are too high.
In the context of what's happening to the UK economy, we would argue that gilts are too high.
By a magnitude of?
By a magnitude that is tradable, we would say at this point in time. Yes, we need to see more data points on the inflation side, but growth is not there. The issue with the UK is because it's a smaller market, it can get pushed around a bit more.
Yep.
Also, because of the last few years and some of the volatility that we've seen in the gilt market, I think there is also a bit of a risk premium that you're seeing in the gilt market that is not helping there as well.
So let's go full circle here and bring it back to the States if we can. Just given that we saw a 12 basis point move off of the CPI print yesterday, and I hear you that you say it's one data point. Look at the CPI numbers. We've been trending upwards for 5 months now. Marginally, but we are trending upwards. A lot of that is driven by a lot of those consumer prices. I hear an egg, bacon, and cheese is now at the scandalous price of about $3 a pop. Does that set us up, perhaps, or the market up, for starting to think about a hike before a cut?
A hike before a cut. I don't think we're there yet. A delaying of cuts, absolutely, and we're seeing that at the moment, right? So pricing out some of the cuts that we were expected to see over the course of the year makes sense. I think, again, the US has got the uncertainty due to the administration and where they're heading next, which is feeding into prices at this point in time. I mean, if you look at the 10-year and where it is today, even after that move yesterday compared to where we've been year to date, we're bang in the middle. Right, of the range. Admittedly, a wide range year to date, but we're back in that middle of the range.
So Anna was talking about the transmission mechanism in the UK. What transmission mechanism? What timeline is the U.S. bond market pricing in right now? Are we still at a 12 to 18 month lag? Is that the way Powell is thinking?
I think he's in a wait-and-see mode, right? We've seen what we've over the last few weeks in terms of the activity of the administration. One thing that we were very conscious of at the beginning of the year is that Trump has been in position before. So he was going to roll out his agenda a lot quicker than he had potentially the first time round. And that's actually what we've seen. But we need to sort of distinguish between the noise, right, and what actually happens. And I think that's what the market is trying to sort of feel out at this point in time.
Pete Hegseth, the US Defense Secretary, this morning, reiterating the Trump line that he would like to see Europe spend 5% on defence. What's the bond market's view of 5% on defence?
That's huge, right? In terms of the increase in terms of spend on the European side, in a context where, if you look at the fiscal side in Europe, they haven't got that much flexibility. Now we have an interesting element coming up quite soon with the German elections, and actually the debt brake has been a topic there. It'll be really interesting to see if that is something that gets lifted. So, not a lot of flexibility on the European side, but that kind of spend on defence would have an impact, and certainly in terms of issuance, if they edge towards that, that would mean more issuance on the bond market.
Does that mean yields down or yields up for the German market?
I think in the German market, if you look at where we're at the moment, I think a degree of that issuance is priced in at this point, but probably not all. So we'll have to see. But the levels we've got now are also reflective of the growth prospects that we're seeing in Germany and some of the work that they need to do on the growth side.
Henrietta, it's been great to see you. Wide range of subjects covered this morning. Henrietta Bankmar, Senior Portfolio Manager at Allspring Global Investments.
Let's get to some of the other big stocks on the move. We were talking about Germany there in the context of the economics. Let's talk about their major banking sector as well. You are seeing risk sentiment completely turning around in Commerzbank. When we earlier spoke to Bettina Orlopp, the shares were at least indicated higher on trade gate pricing. Now you're seeing them down about 0.6%. A similar story over at Barclays, down about 5%. Barclays had poor numbers. Commerzbank had decent numbers, but the market's turning.
So share price down in Commerzbank, is that an indication that the market thinks that this is a standalone business and the numbers this morning are good enough and therefore you take the risk premium out of a deal? Or is it that the numbers aren't good enough as a result of which you price the stock lower and they're being too conservative? Don't know.
Let's get to the defence sector, shall we? Check in on that.
Yeah.
Red on the screen for the defence sector.
But not as much as earlier.
True, it's completely apparent. So is this a momentary rotation then that we're seeing within just the first hour of trading?
If we were pricing in any kind of peace dividend at the start of trade, and we've talked about how it's premature to do that perhaps, but the market is certainly thinking in that direction, then we've unwound a little bit of it, haven't we? Because Stoxx 600 only up by 0.3%. Let's have a look at some consumer names as we bring this hour of programming to a close. A tale of two different consumer-facing companies there. We've got Nestle trading strongly higher after the business. Shares up more than 6% at one point after and in fact, this is the biggest move higher in the shares since February 2009. On the UniLever side of things, they've talked about where they're going to list their ice cream unit and also delivered results. Coming up later today, a conversation with the CEO of Klarna. You can catch that interview at 4:30 p.m. UK time. That is it for the opening trade. The earnings stories coming thick and fast, but also, of course, the geopolitical news. We'll continue to focus on that during the Pulse. This is Bloomberg.